How are you doing, Rob? You ready for this?
I'm ready.
Right on. Why don't we sort of just get started? I don't want to keep people waiting, and as other people come on, we'll let them in. So, welcome those of you who've shown up early. Appreciate that. This is how to evaluate a deal with Mr. Rob Beardsley. My name is Rick Martin, and I'm the founder of Fortress Federation Investments. We focus on multifamily opportunities in the Southeast and Texas. And interestingly enough, we partner with the gentleman I have on tonight. That is Mr. Rob Beardsley from Lone Star Capital. And, he barely needs an introduction, but I'm going to give him an introduction anyway. Sorry, I'm
I'll take
admitting
care of
people as I
the
talk.
I'll take care of the admits. You can keep
Ah,
going.
I appreciate that. Thanks, Rob. So Rob is co-founder of Lone Star Capital. He oversees acquisitions and capital markets for the firm. Has acquired over 100 million of real estate, multifamily real estate. But I think more pertinent to tonight is he has developed his own underwriting model, and he's also authored the best-selling book, The Definitive Guide to Underwriting Multifamily Acquisitions. And I happen to have both. I use his model, and I've read his book, and I've even done a course that he offers, which is excellent. He's definitely an authority on this topic, so we're really lucky to have him. So welcome, Rob. First, welcome, and thanks for doing this.
Yeah, it's good to be here. Absolutely,
Yeah.
some familiar faces.
Yes, familiar names and faces. How this is going to work is Rob and I are just going to have a discussion, keep it pretty casual, hit on some key topics, and then we're going to open it up for questions. So hopefully you guys brought some questions. You can either unmute yourself and ask Rob yourself, or you can throw your question in the chat box and we'll answer it that way. So let's get started. Before we get into the weeds of underwriting, just kind of wanted to start at a macro level. That's kind of a popular topic right now. We have rising interest rates, and theoretically, cap rates rise with interest rates. So everybody's a little nervous that cap rates are going to rise. But then on the other side, you have this other force of an amazing amount of capital in the market, really since 2010, and it really upticked during COVID. So there's this tremendous amount of capital looking for yield, creating this intense demand. So to put you on the spot, who wins? What wins?
Yeah, well, I'm really hoping that we can dive into some really tough questions and you can grill me tonight. But as far as that discussion goes, yeah, I definitely have some thoughts, and then I'll kind of relate it to underwriting as well. But you set the stage well, right? The key factors in the market today are inflation, which our country hasn't seen in 50 years, 40 years, and it's here in a real way. And there's debate as far as how transient it is or it isn't. And personally, I think that structurally we have a very anti-inflation economy, right? People are getting older, people are working less, technology, globalization. There's a ton of things that are leading towards lower and lower inflation. But we have this short-term spike where we kept everyone at home, printed a ton of money, and then demand shot back like a rubber band, and then supply was slower to catch up. And so that's created all this, in my opinion, shorter term inflation. But just because it's shorter term, it's still going to take years to work through the system fully. And we're seeing it in our business in a really big way as far as rent growth. We're not all here sitting on this call as geniuses having predicted 20% rent growth in many parts of the country, right? We like everyone else underwrite about 3% rent growth per year. And, we, like everyone else, got really lucky. And rents have been amazing in the past 18 months. And that has benefited values a ton. The other side of the equation that you brought up is interest rates and cap rates. Cap rates have stayed low in spite of, COVID presented a big risk. And I thought it would have, at the time, everyone thought that the market would have been shocked and everyone would get super risk averse, pull all their money out, want to sit on cash, and cap rates would have to go up to entice investors into risk assets back into the market. But that didn't happen, right? There was a freeze as far as transaction volume, but cap rates stayed low. And then people came back and said, hey, that COVID period, we're all sitting at home not doing deals. Well, now we have to make up for it. So lenders were making up for it with record volumes. Buyers were making up for it with record volumes in 2021. So, like you said, that's a wall of capital on the debt and equity side that have kept cap rates low, even now, in spite of rising interest rates. People have been talking about rising interest rates for almost 10 years, and it hasn't really happened until now. Now it has finally happened. Interest rates have moved materially. We had an inverted yield curve, which I think, it'd be convenient to not talk about, but we should mention it and say that, the yield curve, which is most classically defined as the 2-year US Treasury yield and the 10-year US Treasury yield, inverted, meaning the 2-year had a higher yield than the 10-year, which means that the market is all upside down. Long story short, it is the number one predictor of a recession. And basically, if you believe the inverted yield curve, it says that we should have a recession in about 18 months. I kind of agree. I'd say maybe we even have a recession sooner. I don't think it's going to be a nasty one. I just think what that means is everyone's talking about rate hikes, but the Fed is right now on the clock for rate cuts. Rate cuts are going to happen I mean, it'd be very easy to say 3 years. I think that's a safe bet, but I could even be aggressive and say rate cuts are on the table in 2 years. In 2 years, the Fed's going to be talking about or cutting rates. And I also think that the Fed is going to fail in its objective to raise rates to above neutral. And so, people argue that neutral is about 2%, and 2.5% would push the Fed into restrictive territory. I don't think the Fed's going to get there, but now I'm just kind of putting in all my personal ideas in, and I want to tie it back to underwriting, because at the end of the day, in my underwriting or in our underwriting, there really isn't much room for my personal ideas. I just kind of laid out my macro philosophies, and I hope it was as fun listening to it as it was to say it, but it really doesn't have a place in our underwriting. In underwriting, we don't pretend that we're smart, or we don't think we're smart. We don't try to predict the future. We just stick to our underwriting philosophy. So we're not thinking, well, prices are going to be up or down, so we're going to manipulate our exit cap rate. We use the same exit cap rate as we think is appropriate based on where the market is today, and that allows us to be consistent, compare deals apples to apples, and I would say most accurately or most honestly evaluate opportunity.
So, what are you going about doing in terms of your underwriting? I mean, you have to address it somehow, right? And I know your deals, you deal with floating rate, you deal with bridge debt. You've gotten some deals with some fixed debt if you can find it. Anything? I know you said that you can't allow it to affect your how you underwrite, but you have to have some protective measures in place. So wondering how you go about that, and more importantly, maybe because this is sort of, we're not going to get too deep in the weeds tonight in terms of like an underwriting model. We're going to talk about some some fundamental things that people need to keep an eye on. So what should investors be checking in terms of their underwriting, assuming that the underwriting is made available to them? Not everybody provides their underwriting to investors, but what sort of things should they be checking to make sure that they're not going to get burnt, 3 years down the road when it comes time to either refinance or sell that building?
Yeah, and you brought up a good point about, you have to address it somehow, right? And that's right. The way I think about it is you need to be nimble as far as your business plan. Your business plan can change, but your underwriting philosophies shouldn't change as the market's changing, right? So you brought up kind of fixed rate debt versus floating, bridge loans, and we have experience with permanent debt and bridge debt, both fixed and floating, right? For both products, which it's funny. Kind of a couple years ago, everyone was doing 10-year loans at a fixed rate. And they thought if you were floating, you were crazy, because look at how low rates are today. um, you'd be crazy not to fix for 10 years. This is great. And they weren't necessarily wrong, but it also was a fabulous time to float. And it still is a good time to float. I mean, floating rate indexes are nearly zero. So it's still a brilliant time to float, but obviously there's a lot of projections. The forward curve is projecting rate increases. So anyway, what I wanted to say was, back then we were preferring floating rate debt. People thought we were crazy. It's worked out very well. And then today, everyone is doing floating rate debt, not because they necessarily want to or prefer it, but just because it's the prevailing bridge loan product. But we're now aggressively pursuing fixed rate options in the bridge space. As you know, with one of our deals right now that we're doing fixed rate, which is interesting and is at a lower leverage, which is also a good wrinkle. I think in today's market, given all the uncertainty and stuff, again, we're not necessarily changing the way we underwrite. We're changing our business plan by lowering leverage, right? We've done plenty of deals at 80% leverage, and now we're doing a deal at 70% leverage. Do I think the deal would have been a good deal at 80? Yes. The returns were stronger at 80, right? But leverage cuts both ways. It magnifies all potential outcomes, good and bad. So at 70%, I look at the deal and say, well, the numbers still look good, and I feel a whole lot safer about the risk. So the downside as a sponsor is you have to raise more equity, and you don't necessarily get paid more for doing more work, right? So as a sponsor, you're like, well, hey, let's just load up on leverage, and that way my work is easier. I get to raise less equity and buy the same deal. So as a sponsor, it's tempting because there's a few reasons. This is a bit of a rabbit hole, but there's a few reasons why your leverage is tempting from a sponsor's perspective. One, it makes the returns look better. Two, investors sometimes don't read into the leverage that much, and they're kind of like, hey, it looks good to me. And number three, you raise less equity. So there's a lot of reasons why going with more leverage is awesome. But I think right now, as evidenced by one of the deals we're doing at 70% leverage, there's also on the flip side, very compelling reasons to go lower leverage. We can sleep better at night. The returns are better on a risk adjusted basis, right? The returns are lower, right? Obviously, we're not able to get higher returns with lower leverage. Returns are lower, but we feel that they're better on a risk adjusted basis. And because it's a fixed rate, the cash flow is better. And cash flow is kind of the most important thing I'm focusing on in underwriting right now. Because yeah, we can, Rick and I can go back and forth as far as what we think the exit cap rate should be, meaning what price are we going to sell the property at in 3 to 5 years? But that's 3 to 5 years. Neither of us have a clue. But we can have a pretty good estimate as far as what cash flow will be for the first year, even for the first couple years. So especially on a fixed rate loan, because then we're not really making any hypotheses about the future of floating interest rates. So that's one of the reasons why cash flow is so important, because it's immediate and it's more tangible. We can forecast it more effectively. And it's the constraining factor, because these days with our environment, with rising interest rates and that squeeze between cap rates, where, like you said, the wall of capital is winning the war. It's keeping cap rates low while interest rates are going up. So when that's happening and your spread is getting smaller between your cap rate and your cost of debt, cash flow gets squeezed. So that's why we're very focused on cash flow, making sure that if the deal works on a cash flow basis today, the IRR is going to take care of itself. So that's the thing we're focusing on.
So touching on that, cash flow is attractive, right? It's like it's that you're getting paid during the life of a hold, and I think that's comforting to investors. I'll say, as of recently, as returns have sort of gone down in terms of their projections, it's taking a while, I think, for investors to adjust their expectations. And they may open up a deal alert and see, they'll just kind of read the returns and like, no thanks, next. And they won't understand things about like lower leverage, or that you're building a SOFR curve into your underwriting, which we could talk about a little bit. And maybe we should talk about that a little bit. That's one of the things that I appreciate about the way you underwrite deals. I get deals proposed to me. I'm also a passive investor in addition to being an active general partner. I'm always looking at passive deals, and I get a little suspicious today if I see cash on cash at 11%. First thing I think is, okay, there's probably a refi built in to that, and are they taking the necessary precautions, to ward off rising interest rates in the future? So you do things. You build in a SOFR curve. You build in forward-looking curves. You purchase a rate cap. You just touch upon that a little bit.
Yeah. So the SOFR forward curve that you're talking about is basically, you can go, there's multiple providers of this online where you can just download the market consensus. I'm not sure exactly how they derive the data or where exactly it comes from, but basically, the market has a consensus as far as the future path of interest rates, specifically SOFR, right? Which SOFR is now the de facto short-term index rate, where it was LIBOR. There was, I don't know, 7 trillion. I don't know. It was basically everything was correlated to LIBOR, and now they've switched it to SOFR, which is the short overnight financing rate. And the market has a consensus as far as the future of it. And so, as Rick said, we download that and we update it as often as needed. Before the Fed started going crazy and Russia and Ukraine started going crazy, we only needed to update the forward curve every couple months. And then now you have to update every week because the interest rate path, the forward curve is changing so rapidly. It's very frustrating. But we take that and we put it into our model. So as we forecast every month in our pro forma and cash flow for every month, we're taking into account what the market thinks interest rates will be at that time, for our entire hold period. So if our hold period were 10 years, we would have that future projection, stretched out there. So, that's kind of a no-brainer. It's like, if that information is out there in the world, why wouldn't you incorporate it into your model? Now,
By the way, Rob, not to interrupt, I put a couple sources in the chat box. If people are interested, they can actually get that forward-looking curve information, and they can be Nostradamus and predict the future.
Yeah, exactly. Predict the future. So, no, that's pretty much it. It's it's a good tool to have baked into your model, and I would say it's the most intellectually honest way to approach the situation. You could make a case of, well, hey, I think interest rates are going to be a bit different than what the market thinks. And, I could see the case for that as well. I don't think that's a wrong approach either, but certainly just to say, well, whatever today's rate is, that's what the rate is for the model. That doesn't make sense. We're in a changing environment. So that's one thing. You also mentioned rate caps, which is in a similar vein. It's, I can't take credit for it. I mean, it's a requirement. 99% of lenders on the floating rate side require you to purchase an interest rate cap, but their requirement is very perfunctory or minimal. They're making you buy a rate cap, which essentially puts a ceiling on your interest rate exposure. Their requirement is way up here. So they are comfortable with you floating all the way up here, but we've actually been buying tighter and tighter caps as it's been economic. You don't want to just buy a super tight rate cap and it be really expensive and blow up your deal, because you could be spending hundreds and hundreds of thousands of dollars at the closing table just to buy that cap, right? So you have to be smart with it. You have to look at the market and kind of find that sweet spot. So that's another thing we're doing. So I think that answers that.
So, so we kind of discussed two different strategies. One is, if you have floating rate, you have to, install some sort of forward-looking curve, maybe purchase a rate cap. If you're lucky enough to get fixed debt on, let's say, a bridge is customarily, it's 3 years long, right? You can purchase a couple 1-year extensions. But at the end of that 5 years, let's say you're locked into that fixed rate. Actually, in most cases, right, we're all into value add. We want to implement the business plan, and by the end of maybe 2 years, we want to go out and we want to either seek a refinance or a sale. And if you're in fixed debt and interest rates have risen, it might be better just to sell, right? Because your chances are it's going to be tough to get a refi at a good rate. And it may not make sense. But you're in two different situations there. You could either do the floating rate or you can do the fixed. Not saying one is better than the other, but do you have an opinion? Do you think one might be better than the other? What does that depend on?
It depends on the market. So a couple years ago, I would have I would have given you so many good examples and I made videos about it as to why you would want to float. And generally speaking, if you want to just look at the hard data, it's almost always better to float. It's just harder to sleep at night with floating rate debt, but it's superior. And if you read the Pensford stuff, which Rick linked to in the chat, they've done lots of great analysis on fixed versus float. And basically the consensus is there has never been a period in history over a 10-year consecutive time where it has been superior to fix versus float. So floating's always better over a long period of time. There are kind of shorter 3-year periods where fixing is superior, but at the end of the day, when you fix and you're wrong big, and when you float and you're wrong small. So I don't know. Don't take it from me, but read the Pensford stuff. It's really interesting. I like the Pensford stuff. I hate that I give Pensford so many commercials, always saying, "Oh, good newsletter, good research," and it's like, wow, can people do that about me? That would be amazing.
You're their biggest
But
fan.
yeah, but yeah. So that it's all about the market. Today I would say, well, if the Fed actually accomplishes half the rate hikes that they want, and Citigroup is projecting that Fed raises 13 times. It's ridiculous. So if they accomplish half of that, floating is expensive, and if you can fix today, in the low fours, it's very attractive. But would I be willing to? So it's an interesting point because would I be willing to fix for 10 years? No, I would not be willing to fix for 10 years. I'd be very reticent to do that, especially when you consider the fixed rate options for 10-year money today. 10-year money is super expensive today, right? Bridge loans historically and structurally are more expensive than fixed rate, than permanent debt. And they should be, right? Because bridge loans are a riskier product. On a permanent loan, the lender is lending on in-place income. It's a slam dunk for them. On a bridge loan, the lender is lending on future income. They're going into partnership with you and they're taking a gamble on you. So historically, bridge loans are more expensive to be compensated for that execution risk. However, because of the market that we're in, there's various reasons for it. But one of the biggest reasons is because there's been so many entrants into the bridge loan space, that crowding has caused bridge loan pricing to come down. So bridge loans today are cheaper than permanent debt. So why would I fix today on more expensive debt over 10 years when I personally think that we're going to be in store for rate cuts in 2 to 3 years, right? So I would not fix for 10 years. I would absolutely fix for 3 to 5 years today with the flexibility of getting out, right? I can fix for over a 5-year term when you factor in the extensions, but I can also get out in, let's say, 18 months at a minimum penalty. That's the other nasty part about fixed rates is you get caught in them with a yield maintenance penalty and you're stuck. You're totally stuck. So I like flexibility, and generally you have to float to get that flexibility.
Okay. Along those lines, most deals that you see, they're going to be underwritten at a 5-year hold. You guys do a lot of underwriting at a 3-year hold. Can you just touch on why that is for those that don't know?
Yeah, it's a great point. We get asked that a lot because, like you said, most people are used to seeing a 5-year pro forma, and we do a 5-year pro forma on an agency loan. So when we are borrowing 10-year money, we'll do a 5-year pro forma, and on a bridge loan, we'll do a 3-year pro forma. And the reason for that, it's a very simple reason. It is, well, it's really two things. Number one, it's to match the term of the bridge loan, right? Which bridge loans typically have an initial term of 3 years. So we want to match the initial term to the underwriting model hold period. But the 3-year period is also a more accurate reflection of what should or hopefully happens on the bridge loan. with a bridge loan, we don't want to be on it for a long time, generally speaking, right? Those extension options to get you into year 4 and year 5, that's a downside scenario. You're only using those extensions if your business plan is taking longer than expected, or the market takes a downturn and it's just not a good time to sell or refi. That's why you'd want to use those extensions. But generally, you don't want to really use the full 5 years on the bridge. So every bridge loan we've done, we've refinanced out of it in 18 months. Is that how it's going to be every single time? Probably not. But that's the idea. So we're either selling or we're refining and hoping to do it in about 18 to 36 months. So by underwriting a 3-year hold, I'm not going to say that's conservative, right? Because we've been told by investors, well, hey, I like to see the 5-year hold underwriting because if we exit in 3, there's upside there. But you're already underwriting to 3, so where's the upside, right? So I get that. That's a fair point. But if you sensitize the returns across those hold periods, it doesn't change the numbers that much. But yeah, so that's why we do it. And yeah, I think that answers kind of both those questions.
It does have an effect on the returns, right? The the shorter the hold, the more the IRR might get juiced. But if you hold longer, the cash flow should go up, right? It's going to have more of more time for that cash yield curve to kind of uptick. So I think it's kind of a comfort thing for people. They're like, "What, 3 years? Why 3 years?" So they don't get it. But really, most business plans in the value add business that we're in, it should almost always be built around 3 years, because after a couple of years, you're gonna be doing something. You're gonna be having some sort of event, right?
Right. Some sort of event. And I also think there's also an element of complication when you have a bridge loan matched with a 5-year pro forma. I'm sure you've heard me talk about this before, but it introduces so many tough decisions to make, because if you want to underwrite a 5-year hold with a bridge loan, are you assuming the exercising of those extension options, which can be costly? They cost anywhere from 25 basis points of the loan amount up to 1% of the loan, which is very expensive. So that's one way to do it. But that doesn't look good. You could bake in a refi into your underwriting, but then everyone throws up on that. So you don't want to do that. You can just pretend that your loan is 5 years, right? Which is just dishonest. So yeah, there's not a clean way to match a bridge loan to a 5-year pro forma.
Yeah. Well, we got pretty deep into the weeds right off the bat. I was thinking we would sort of start at a general level. Passive investors. Just speaking about passive investors first off. They're passive for a reason, right? They don't go to school to learn how to underwrite. Although I don't know, Rob, maybe you expect everybody to be able to underwrite at a high level. My guess is that most passive investors are not, and if they are, who knows? They might be making mistakes and talk themselves out of a deal because they made an error or something. But let's back up on like a market level. When someone's they get a deal in their box, they have an investment opportunity in front of them. What are some fundamental things, or maybe even websites, that they can go to first, like, just evaluate the market? They can read through the investment summary and see all the good things that are happening in the market. Now they need to do their own due diligence and sort of verify that. You have a few go-to websites that you could sort of suggest for people.
Yeah, so I like to preach to start with the qualitative before going to the quantitative, because once you dive into the numbers, you can twist around the numbers and they can start speaking to you in different languages and you can convince yourself of anything. So before you go do that, you should just look at the qualitative and get comfortable with that first. By qualitative, I mean things like the market that it's in, the location, the age of the property, the school statistics, crime statistics, median household income, population, all those things that don't explicitly end up in the underwriting, but implicitly do by way of the strength of the market, the exit cap rate, the rent growth projections. So, as far as a resource, I'm a huge fan of justicemap.org. I believe it's a
Mm-hmm.
.org. So
Mm-hmm.
Justice Map, it's a free resource. Obviously, we could talk about paid resources, but for
Mm-hmm.
the purposes of this question, Justice Map is an awesome free resource because you just type. That's the first thing I do. If I get a deal in my inbox
Mm-hmm.
and I'm a passive investor, I'm just going to put it into. I'm going to put the address into Justice Map, and I'm going to see, is this deal in a 20,000 median household income
Mm-hmm.
census tract or block, or is it in 100,000? Right, that'll give me a super quick sense of the location, and kind of I will be able to couch my analysis, or I'll be able to look at my analysis through that lens, right? If I know I'm looking at a deal that has, $35,000 median household income, okay, I know that. I'm already kind of looking at it from that angle. I know it's, low income housing.
Mm-hmm.
I shouldn't see stainless steel appliances in the business plan.
Mm-hmm.
I shouldn't see, $1,500 rents in the business plan. So, I can look at it from that angle. Also, I shouldn't see a super low exit cap rate. So
All right.
Justice Map would be the first thing I do. And once I get comfortable with the qualitative, then I look at the quantitative through the lens of the qualitative, and then dive into the underwriting, which, as you know, is not trivial. And it I'm reticent to tell people to do a back of the napkin because, as you know, garbage in, garbage out, and it's almost impossible to do a back of the napkin where, oh, just plug in this and this, and because deals work on the margin. It's the little things, it's the little parts of the business plan. But to zoom out a bit, I think our debt discussion was super helpful. And as an investor, just looking at the debt and seeing, does this
Yeah.
make sense to you? And when we do most of our deals, we've done at 80% leverage, and we get plenty of investors who say, "Oh, too much debt for me." Okay, I can't. There's nothing I can say about the deal that's going to change their mind, right? That is the debt. I can't say, well, the area is really good, right? That just doesn't work for them. So find out what works for you, and also why. Don't just because somebody told you that 80% is too much. I wouldn't just make your decision about that. Have a really good defensible reasoning for your criteria, and then move accordingly, or move forward accordingly. So debt's big, the rent projections are big, and then the exit cap rate is big.
All right. We're going to touch on all of those. But I have to ask you. Well, you're entrenched in the Houston market, so you know it well. But back when I was exploring different markets, I used judgmental maps every once in a while on the bigger markets. Did you ever happen to use judgmental maps?
No, I haven't heard of it.
Oh, it's if anything, it's entertaining. That's where it'll literally say, crack dealers, hookers. Um, I'm telling you, go there. If for any
That's
reason
awesome.
you'll laugh, but it actually, in a judgmental way, it paints a picture of a metropolitan pretty well. But it has to be sort of a larger city. But yeah, there are the other websites like City Dash Data and bestplaces.net. There's the Bureau of Labor and Statistics, but they all seem to be about 2 years behind. So I always tell people, if you have a buddy in commercial real estate and they can get you a CoStar report, that doesn't hurt. But yeah, I like judgmental. I like Justice Maps as well.
Yeah. Yeah, this is hilarious. Judgmental maps is good. I'm on the homepage. There's me right there where the yuppies work.
Yeah, exactly.
Perfect.
Exactly. And it actually, I'm telling you, it can kind of frame up a submarket pretty well. So you sort of touched on like the most important things. I was going to ask you that next. In fact, it was on the flyer. What are like the three top metrics that people should really verify? And you touched on rent growth. You touched on the exit cap, which is popular to talk about. Yeah, take it away.
Yeah, so rents are a very big button. They drive a lot of the deal. So what rents you determine to go with has a big impact on the projected returns. So, you need to focus on them because they're important. However, something that's, you know, apparent today is rents are growing very quickly. And so we've been more aggressive than normal with our pro forma rents because we have that in the back of our mind, the confidence that, there's a lot of inflation. Yardi and CoStar are telling us that rents are going to go like this. So maybe we can be more aggressive on our pro forma. So, um, so that it's kind of more of an art than science, but certainly having rent comps to justify your pro forma is key, right? That's how you're deriving your business plan and arriving at your projections, right? When we go look at a deal, we don't just say, well, you know what, these kitchens would look great with granite countertops, and because they look great, we're going to raise the rents, right? We need to have a deal down the street that already did it, and we're going to do it, and we're going to copy them and then shoot for their rents, or maybe we're going to do a little better than them because we have a nicer location or better management or better amenities, right? It's finding the justifications for why we can raise rents, not just throwing money at the deal and saying, well, because we threw money at the deal, now we can raise rents. There needs to be a justification. So that's rents.
Can I ask though first if a passive investor is going to verify the projections that you've put in your underwriting? What might be a good way for them to do that? They go to Rentometer and call it a day, right? That's all there is to it.
I mean, even apartments.com is a good place to start.
Mm-hmm.
Well, I would say probably the best place to start. It depends how honest the sponsor is, but a good place to start would be their rent comps, because they should supply you their rent comps. Which, you know, the reason why I say honest is because if I want to make a deal look really bad, I can make it look really bad. If I want to make it look really good, I could also make it look really good. And what I mean by that is my selection of rent comps. I can pick deals that are further away in a better, non-comparable neighborhood, that are newer properties, that are nicer,
Mm-hmm.
right? And I'm going to say, well, look, the rents are $2,000 over there, and we're only at 1,200, right? The rents,
Mm-hmm.
there's so much room.
Mm-hmm.
But is that really true, right? Conversely, I could also pick out all the junky deals nearby that are undermanaged, that are in bad shape, and I can say, well, look, I mean, how could you raise rents? Look at all these deals that are cheaper. So rent comps are another, very much art, not science.
Mm-hmm.
I think so. One, if you see someone who's, and I don't want to make a blanket statement because it depends where you are, because like here in New York, a block could be not comparable, right? You could have $10,000 rents or $2,000 rents on a block basis. So, your radius needs to be this tight. In Houston, where there's a bit more room and you're driving a bit more, okay, fine. We like to do a mile radius for rent comps. We pretty much don't need to go outside of that. So if you see someone pulling out a 3 mile radius for rent comps, that's a red flag, total red flag, because that is not a comparable market, especially if you pull up judgmental maps or justice maps and you see like your deal is where, judgmental map says, I don't know, something politically incorrect, like poor white people who vote against their interests. And then like the comp is like, here where it says, super rich young people with high paying jobs, right? Like you
Exactly.
can't, those aren't comps. They're just not comps. So
I'm telling you,
make,
judgmental mass, man.
yeah, judgmental maps. That's my new one. So I think the key phrase is you need to have demographically comparable rent comps where the incomes are the same, the neighborhood feels the same. So if that is 3 miles away and it's still comparable, then that's fair. So
Okay.
yeah, that would be the rent comps art.
All right. So yeah, big one. So let's see. We've talked about the debt. We've talked about rent comps. Um, we could talk about expenses, but let's talk about the exit cap first. You know, people, you'll get a prospectus, and on there you'll see the going in cap rate, which in a value add plan, I don't know, maybe it doesn't matter. You'll see the exit cap. But what should they be measuring that against, right? They should try to figure out what the prevailing market cap is, right? to really
Yeah.
verify what that exit cap should be. So again, how are they gonna do that? How are they gonna find out that prevailing market cap? I know you guys, you'll underwrite 100 properties over 90 days, so you have an amazing sample size to really get granular and narrow it down. But for again, for like a passive investor, they're gonna want to gonna want to verify that as well. So yeah, how can they go about doing that, or should they just take our word for it?
Yeah. I mean, you're bringing up the key piece of the equation because most people are discussing or arguing about the exit cap rate spread, meaning how much they're increasing their exit cap rate from going in. And they're saying, well, we do 10 basis points per year, or we do 50 basis points, or we do 100. And all that is the easy part. That's just takes care of itself. You hit it right on the money, which is the hard part, is to figure out what is the prevailing cap rate in the market, right? It's it's up to your discretion if you want to be conservative and say, well, the market is X today, and I'm going to do X plus 1% as my exit cap rate. Meaning, let's just take an example. Let's say the market cap rate today is 4, and you're going to say 5 is my exit cap rate. That what I would consider to be conservative.
Mm-hmm. So would I.
But people are not talking about the critical piece, right? That whether you're raising your 4 to 4.5 or 5 is less important than actually figuring out what that baseline is, you said, which is the prevailing market cap rate. And I'm really struggling to give advice as to how to figure it out, because I was thinking, well, maybe they should just call a broker in the market because they know. But brokers underwriting is just different. Also, it's not worse or better; it's just different. So it's hard
That's
to
true.
really get that data from a lender. You could call a sponsor like me, but now you're trusting me, which, am I trustworthy if I'm asking you for money? So that's a risky proposition. Um, so yeah, I don't know. It's a tough one to know what the prevailing market cap rate is.
You and I have talked about, on some of the past deals that we've done together, we've sort of discussed co-stars cap rates, and I think you're the one who told me that they usually come out about a point higher or a point too conservative, and also, the sample size might be a little small anyway. But would co-star be a good place for people to start, or is that going to make them think, oh wait, cap rates are much higher than what they're saying? I think I think the latter.
It's a risk. I mean, we always know that we've got someone who has no idea what they're talking about when they say, "Yeah, I'm looking to buy a 7 cap." And it's like, "Whoa, that's never going to happen."
Hmm.
So with CoStar, yeah, they CoStar CoStar is just a derivative of the brokers, because where does CoStar get their data? They get their data from the broker. You can read their blurb, and at best, their cap rates are the seller's cap rate, you could call it. And the reason why there's a difference is because the seller often has a lower tax basis, so they're paying lower property taxes. So when they sell the property and they look at their income, yeah, I mean their cap rate is maybe higher. But even then, still, it's not accurate. So I would be careful about relying heavily on CoStar's cap rate data. A lot of CoStar data is tremendous, right? As far as their rent comps and property data and things like that. But the exit cap rate, I'm not a fan.
Okay. I know it's hard to predict the future. Also, but I was going to also say, if I think one more thing that people might want to keep an eye on. Again, talking about a value add business plan. Pretty much the plan is to go and change the perception of the building, renovate it, and hopefully get a tenant profile that is able to afford the new rents. So push the rents a bit, right? So that first couple of years, the rents are quite aggressive in a business plan, in a value add business plan. One other thing should they be looking at, are they are they counterbalancing those, that pretty aggressive rise in rents with a fairly aggressive rise in vacancy?
Yeah, it depends on the plan. So some plans may include wanting to actually force vacancy in order to be able to do the plan faster. Other plans just involve natural turnover and trying to maintain occupancy and stabilization while you renovate. We've done well. I can't really say we've actually forced vacancy, but we've bought property with big existing vacancy, which afforded us the opportunity to do a ton of renovations up front. Uh, but generally speaking, what we like to do is, because these types of workforce housing properties, they have, in our space, around a 40% turnover rate. We'd always like to get that lower, but with a 40% turnover rate, you're going to see all the units in short order. So what we do is we project a 24-month renovation timeline, and we've always been able to hit that. And we're able to, I mean, maybe we're not renovating every single unit, but we're getting to our pro forma rents, we're stabilizing the asset, we're getting to a new proven out value, which is, at the end of the day, the big goal. Yes, we want higher rents, but the big goal is to get higher value of the property. So I think it's the three, there's three levers. It's how fast you want to do it, and what occupancy you want to maintain while you do it. And maybe that's just the only two levers. I don't know. Maybe the third is uh, how involved, how many of the units you want to renovate. Because some people just renovate a portion, prove out the plan, and then get out. But yeah, so I think basically how fast and what occupancy, and then that's just a balance.
Yeah. We sound ruthless, pushing the rents and da, da, da. But really, while this change is going on in the building, it's pretty cool what's happening. You're making the building more secure. You're adding things like a playground, some gas grills. You're sprucing up the pool. Maybe people want to stick around for that, and they might be willing to pay a little bit more. Those things don't come for free, but you're making a better, more secure living environment. So maybe people do stick around, and they see that their lifestyle is going to get improved. Who knows?
Yeah, we've completely changed the culture of properties, rebranded them, fixed crime. Yeah, crime is a great way uh, to really create a lot of value, because if you fix crime, that means that kind of rises all ships. You can start really doing things for the property.
Yeah. I'll never forget just doing walkthroughs on a building we had in Augusta. Um, you had two worlds living in there. You had families that were in there, and their kid. It was the height of COVID, and kids were in there doing their remote schooling, and you could just see it. These families, they just want a secure, good place to live. And then out in the parking lot, you got a couple guys like drinking some old English out at 11 a.m. So, you could see who was going to get weeded out and who was going to be appreciative of the changes, for a bit of a margin. So, yeah, that part of it's pretty cool. Um, I don't want to monopolize all the time. I want people to ask questions if they have them. Is there anything that we missed, Rob, that you wanted to talk about, or should we just open it up to the people?
Yeah, let's open it up. We'll start it off with Justin, who sent me a direct question here about year one economic vacancy and loss to lease. So, for example, if the T12 has 10% loss to lease and the sponsor shows 2% loss to lease in year one, is that aggressive? Is that appropriate? And then also, how does that tie into the other economic vacancy numbers, which I'll explain in a second, for the projection? So first off, if I'm, in a vacuum, if I see 10% to 2%, seems pretty aggressive to me, for loss to lease. All right. How are you really going to get in there and release every single unit? You can't. So we would never do that. But you also you can't look at it in a vacuum, right? Because maybe it's a 6-unit property and all the units are month to month, and you can just fix the lost lease in 3 months. Most likely not, though. But yeah, you just have to look at the full picture. And then, so economic vacancy incorporates all forms of economic loss. I don't really like the term economic vacancy because I think it's confusing. I like economic loss or just losses because they are loss to lease, which means the market is leasing this apartment for $1,000, but you sign this lease to your good friend at 900. That's $100 loss to lease. So loss to lease, vacancy, which is just a lack of heads and beds, concessions. I'm giving you a discount. I'm giving you a TV, whatever it is. Non-revenue unit, which would be I'm using a unit for storage. I'm using a unit as a leasing office, or an employee unit, which I'm giving my maintenance guy a free unit for him and his family. That's another economic loss. And then finally, bad debt. Bad debt is the tenant owes me $900. They didn't pay me $900. And now, so what the way that actually works is first, non-paid rent goes to delinquency, right? It becomes delinquent rent and it sits on your balance sheet. It's an asset. So it's an asset that's on your balance sheet because you're owed this money. And then eventually you give up and you say, this person is not going to pay me. And you write off that delinquency off your balance sheet, and then it hits your income statement as bad debt. So that's a funky game as well, but that's just accounting, and I'm not an accountant. But those are your economic losses. And when someone says economic vacancy, they're talking about the whole thing. So they're not talking about, 9 units occupied out of 10. They're talking about all the losses attributed to what we just went through. So what we do is we look at the in-place economic losses, bad debt, vacancy, loss to lease, concessions, and then we forecast our stabilized projections, right? So the current occupancy might be 93%, and we want to project out to stabilize to 95. The loss to lease might be 4%, and we want to burn it down to only a 2% loss to lease, etc. So what we would do is we would take a linear function from where they are on the T12 or the T3, T1, which would mean T1 being the trailing 1 month, T3 being the trailing 3 months, trailing 12 being the last year of performance. We take it from that baseline and then we use a linear function to grow it to that stabilized figure. So, and like I said, we're typically doing a 24-month stabilization period. So to go back to Justin's question, this is taking really long. 10% loss to lease in on the T12 to go to 2% stabilized, or in his case he's saying in year one, that just wouldn't work for us because we typically do a 24-month stabilization. So we would go from 10 to, I don't know, maybe 6, and then in year 2 it would be, or maybe it's probably even, I don't know, I can't do the math myself, but yeah, it'd be like 10, maybe 6, then 4, and then in year 3 it's 2. So that's our logic behind it. So I would, to answer your question, I think it is aggressive.
Okay. We have one from Mr. Ruben Greth. Ruben asks, how much can rates increase before it causes an economic meltdown? Everybody wants to know this.
I have no idea.
Come on, Rob. You know the answer, don't you?
I think it's fascinating to see just how sensitive the market is not to rates. I would think that people the market moves slow, so there's still time for people to freak out, but the interest rate move that we just experienced was unbelievable. I mean, the 10 years at 2.6%. That's not unprecedented by any means, but that's just a huge move. And the fact that, cap rates are still the same and prices are aggressive and we're fighting over deals with buyers and sellers, it's surprising. So I don't know how much more resilience the market can have. I want to actually say something that was just me guessing, but I want to say something intelligent actually about this topic, which is really interesting. So most financial products like real estate is heavily correlated to the U.S. Treasury yield, the 10-year U.S. Treasury yield. And that went up a ton recently. And if you were an agency debt borrower, you were borrowing 10-year money, that would be majorly impactful to your underwriting, because all of a sudden, instead of borrowing money at 3.5%, you're borrowing money at 4.5%. And that's going to impact cash flow, your IRR, everything. But the fact of the matter is, the majority of market participants today are not borrowing 10-year money. They're borrowing bridge money. So they're not as correlated or dependent upon the 10-year US Treasury yield. They're correlated to SOFR and lender spreads. And lender spreads, I don't really know if they're more volatile for bridge loans than they are for fixed rate, but I believe they are, um, because they're moving a ton right now. So the point is, with the market the way it is, at being more dependent on bridge loans, I actually think that there's a chance that it's less correlated to interest rates. So interest rates can go up, the 10-year goes up, but this market might just keep plugging away because everyone's borrowing short-term debt based on SOFR, and SOFR is at 30 basis points right now. And yes, SOFR is going to move, but it's not going to move, hopefully not aggressively. But the SOFR is directly controlled by the Fed. And the Fed, yes, they have a history of hiking us into recessions, but hopefully they're learning their lesson. And they seems like they've been learning their lesson. So I think the Fed is going to be more modest with their
Rob,
moves here.
Rob, great presentation, man. Very excited about what you had to say today. Just real quick, I have to bounce here in a few minutes, but I wanted to leave one last question with you. A lot of syndicators out there are projecting and underwriting with a refinance 3 years down the road. And I don't know that they're all calculating this increase in rates that is going to be expected. Do you see like a lot of problems with that? Do you think that there's a certain limit that lenders are going to be able to go to, or I should say, the Fed can allow and still have syndicators make money, or is there some looming problems with that?
So fundamentally, I don't think there's a problem with projecting a refi into your model. The problem comes with what you said, which is all the subjectivity about where are rates going to be in the future, where is leverage going to be in the future, right? You have to make many assumptions about the future when you do a refi, which the less assumptions, the better, right? That's safer play. So, I think we can certainly withstand some more rate hikes, but I don't think we can withstand what they're projecting. I think if actually what happens, what is being projected in the market, I think the market's overreacting. If it actually happens, I think it's going to be very impactful to the market. I'll be very surprised if it's not. But like I said at the beginning, I think rate cuts would be right around the corner. If the Fed goes, oops, we tipped it too far, and then they're going to cut and try to stimulate growth and stuff as the market changes. I think that is, that's everyone's concern.
Hey, Ruben, before you go, you asked the question, can you speak to my experience working with Rob in the past? And I would say if I was like a nosy mom and I had a daughter about Rob's age, I would probably try to marry her off to Rob as long as he didn't try to make her sign a prenup or anything. That's how highly I think of Rob. All right, let's see. What else do we got? Does that answer your question? Okay. No, Rob and I, we've worked on several deals, and it's awesome experience, and it's only getting better. Only great things to say about Rob, that's for sure. Let me see. Who else is next? Let's see. Bernardo just wanted to find out where Judgmental Maps is. He got that. And then Mitch, our friend Mitch, asks thoughts on apartmentloanstore.com for cap rates.
Yeah, I'm on the website right now, and I'm not seeing the resource, but would love to.
Yeah. I don't
So
know.
yeah, Mitch, let us know.
Yeah, they come out with cap rates for all the different cities and different asset types, and that's what I actually use for current cap rates now. I mean, if you were to just Google, like I live in Cincinnati, Google Cincinnati average Cincinnati cap rate, and that for me that's been the first source that pops up, and I heard it on a podcast once, so I use it pretty often, but I want to know if anyone else does as well, but I guess not.
Is it a newsletter to sign up for?
No, it's just.
Oh, so just if I am a good enough Googler, I should be able to find this.
I think so. I mean, Cincinnati average cap rate, and that's the first one that pops up for me. Apartment loan store, the second one that pops up
Got
for
it. I
me.
see
But
it.
yeah, yeah. So it has different asset types and the average cap rates or the ranges of them. So I'm just wondering if any of you wise guys use it.
I have not. I'll look into it though. By the
Cool.
way, folks, you should know that this will be recorded. So if you weren't taking notes, don't worry about it. You'll have it for the rest of your life if you want it, and you can save the chat also to look at some of the websites that people are suggesting. Okay, Sarah Daniels has a question. Did you see that one, Rob? Experience with any tax credits written into the underwriting?
Yeah. So I mean, the affordable housing space with a capital A is a very interesting, nuanced space that we are just just getting started in. So there's tax credits, there's tax abatements, there's nonprofits, there's bond issuances. I mean, there's a lot of stuff. So I don't really want to. I mean, I don't. Yeah, so I don't really want to answer the question.
Hmm.
It's a complicated world, and we're just getting started. And there's people that are that's their whole thing. So it's a fascinating game. I think there's value to be had there. But if you have a more specific question, then maybe I could try to answer.
Okay. Put that in the chat if you do, Sarah. Moses, did you have a question? You got your hand up.
Yes, Rick, thank you. Rob, big fan of you. I'm a fellow New Yorker. Good job. I just wanted to ask, looking at many deals coming through the pike, and a lot of them obviously are either not living up their hold period because cap rate has, significantly compressed. They're exiting sooner, so IRR are through the roof and what's not. But I usually pay attention to my equity multiple. That's what I can spend, not the IRR. So my question to you is it worth looking at deep a value add when you got so much cost going into the deal based on your return, like cost of return on the acquisition compared to just sitting on a B plus or an A class asset. I don't know if I get that clear to you what I was trying to allude to.
Yeah, I think I understand. It's a good question. That's a big argument with people who, is it better to sell your deal and buy a new one, or better to just hang on to your existing deal, right? A lot of long-term owners just like the consistency of their deal and avoid reinvestment risk. I think this question comes down to reinvestment risk. That's really what it's all about. And what reinvestment risk is exactly what it sounds like. You sold, let's say, for example, you sold a deal and now you've got all this cash coming back your way. And now you have the risk of having to reinvest it. And, maybe you reinvest it at a rate that is inferior, or at a return on equity that is inferior to what you previously owned. Right. So that is a concern. But, the reason why I think it boils down to reinvestment risk is because, let's just say, in a perfect world, you had an unlimited stream of great deals, which, maybe you do because you're networked with good sponsors. It's certainly easier as a passive investor to have a never ending stream of good deals because, you can partner with many different sponsors and all sorts of good stuff. So point is, if you make the assumption that you are always able to invest in a good deal, then you really should have no problem in selling whatever you have now and rolling it into the next one because of the value add lift, right? You may be in a deal that's cash flowing super well and doing really great, but you have to look beyond the cash flow and you have to look at your return on equity, because you have to recognize that you have equity built up in that project. So the cash flow that you're receiving is not just a cash on cash return, it's a cash on equity return. So you have to identify, okay, how much equity do I have in this property? Maybe I have $1 million of equity in this property, and let's say you're getting $100,000 in cash flow per year. You might say, wow, 100 grand in cash flow. This is amazing. But that's a 10% return on equity. Can you go and get a superior return on equity? Well, if you believe every single deal alert that gets your inbox, then yes, you should be able to get a 15% return on equity. So you sell that property, invest in a new deal. The sponsor implements the business plan. They put in all this effort, raise rents, improve expenses, improve management. And now you're getting a 15% return on your equity rather than the 10%, even though that cash flow looked good. And then the other benefit are the tax benefits, because the longer you hold a deal, you amortize down the tax benefits of that deal, and they could eventually run out. So, especially as a passive investor, if you're the one not doing the work, then you should put in the work of finding good deals and then sitting back and collecting checks. But if it's you doing the work and you're the manager, that's why you see mom and pop owners own forever, because they buy a deal, they get comfortable owning it, they know the tenants, they know the market, and they just sit because it's so much work to sell that deal. And now they have this huge reinvestment risk. This was their nest egg, and now they have to reinvest it into a new deal, new market, and spend a ton of effort on the construction and renovations, and they're going to have worse cash flow going in. So as a passive investor, big fan of selling, getting into the next one, and achieving a higher return on equity.
Thank you.
Right on. Okay, we got a question from Stuart. By the way, we're just past the hour. I think we just have a few other questions remaining, and we're pretty close to wrapping it up within the hour. So from Stuart Berryhill, do you underwrite trying to leave a certain amount of meat on the bone, or just try to achieve market rent in all units and sell based on cap rate?
Excellent question. So this is a fun question to answer because, basically the amount of money we pay brokers to sell our deals, they need to be good enough at their jobs to take whatever deal they're selling and pitch it as if it has meat on the bone. So I don't worry about leaving it on the bone because the broker is always going to find a way to pitch meat on the bone. So
True.
it shouldn't be a concern of yours as far as, well, we shouldn't, knock this renovation out of the park because we're going to get dinged on the sale because there's no meat on the bone. Trust me, there's going to be meat on the bone. Someone's going to be crazy enough to envision some sort of value add plan for your deal. And if not, the brokers shouldn't, they don't deserve their commission.
Yeah, sounds good. From Jawan, I hope I got that right. What about if you were on the title but not on the loan? What steps should be done?
I have no idea what that's talking about.
Is he talking about a tick maybe?
Maybe. Yeah. Do you want to help us
Is he still on?
clarify?
Oh yeah, he's still on. You want to unmute yourself? Let's see. Do I need to ask him? Jawani. God, I don't want to get your name wrong. Jawani?
Juanine?
Jawani Harrison?
Yeah, hi, that's me. I was wondering if you're wanting to purchase a property and it has that situation. Is there like steps? Does it have to go through the probate issue, or can you purchase it with it being like that?
I'm not familiar. That's not really my expertise as far as probate and title. So I don't know.
Okay. Okay. Thank you.
Yeah, no problem.
Okay. You guys seeing that?
Yep.
Okay. How are we doing on questions? Do we see any more questions? Anybody have any more questions? This is your chance. It's not every night you get to hang out with Mr. Rob Beardsley. Are we good?
Yeah, we got Matt raising his hand.
Oh, nice. Go for it. Can you, let's see, there we go. Unmute. Yeah, there you go, Matt.
Yeah. Hey, Rob. Great presentation. Really appreciate it. I actually experienced an underwrote deal that had a 15-year tax abatement. And my experience was that the lenders that were going to lend, like on a 5-year or 7-year loan, they didn't really care about the abatement since their term was going to end before the abatement ended. And my understanding is that the abatement, you want to treat it like it's an asset, and include that in the underwriting.
Right. Yeah. If you can get your lender to treat it as capitalized value, I mean, it's a home run.
Yeah, I found a website that I'll probably put in the chat that talks about how to include that in the underwriting, which I found very helpful.
Yeah.
You see that question from Bernard Do? I bet I know what I bet I know your answer. There's only one, right?
Yeah. I mean, there's plenty of good models out there. Ours is available for free on our website. You can check it out. Um, I think it's more important that you pick one and stick with one. You know, someone put, Matt put in the Adventures in CRE. That's good stuff. Yeah. So Adventures in CRE has amazing resources, really robust institutional models. My model is not as complicated as theirs, which is why I like it. But yeah, I would say I'm not going to mention any other but mine. So check mine out on our website.
Yeah. Yeah, I will say what I like about using your model, Rob, is all the inputs are on one page. You're not jumping around from tab to tab. That can get a little disorienting. So, and it's free.
Right.
Come on.
Yeah, yeah, you can't beat the price.
And in all seriousness, the good thing about that is if you ask if we can share our underwriting, we will, because we got nothing to hide. Whereas sometimes you'll have a deal and you'll ask to check their underwriting, but their model is proprietary or whatever, and they won't allow you to see it. And I would say at least just push back a little bit and at least get a PDF version or something and get some sort of printout. Maybe I'm not sure. I guess they're afraid you might steal their formulas or whatever, but always push back if you do want to check out the underwriting. Let's see what else. We got more questions coming in, folks. V, I hope I got that right. What resources did you use originally to learn how to evaluate these deals, i.e. books, websites, etc.? I'm quite new to all of this. You remember?
Yeah, unfortunately, I pretty much taught myself, which is why I wrote my book, The Definitive Guide to Underwriting Multifamily Acquisitions. So
Nice plug, man.
Yeah, it's a bit, yeah, there it is. Perfect. Matt's got it right there. So it's kind of like a 101 combined with a 201. It gets advanced pretty quickly, but if you kind of have the basics and you made it through this webinar tonight, then you're probably ready to dive into that book. 100 pages, no fluff, and it'll be a great way to just start diving in. So I wrote that book because there was nothing like it in the market. Maybe there is today, but I was just surprised when I was learning the business that there wasn't a resource like this. You know, people had paid weekends or maybe courses and stuff like that. So yeah, I would check that out.
And going back to Bernard Du, I'm butchering everybody's name.
It's Bernardo. It's okay.
Bernardo. I should know that. Bernardo. Okay. Sorry, Bernardo. To answer your question about underwriting models, there are so many limitations on a lot of the models. It's hard to find a model that will do, A/B structure, a waterfall, preferred equity. I think you just want to see, you want to be sure about everything you need to know is covered in the model, because there are models out there that are quite limited. It's tough to have everything, but some of them do a better job of having everything than others.
Yeah. You want to look at usability and then features. You don't have to have every feature, but being able to refi is good, even though we don't advocate baking it into your model. But the ability to refi is good. Rick mentioned the dual tranche structure, the Class A, Class B. There's speaking of which, I needed to send out my newsletter today and I forgot. That's crazy. I need to put a note.
You're busy.
My newsletter that's going out yesterday is about Class A, Class B structures and stuff like that. So newsletter. But yeah, and then I think that's something critical is monthly pro forma. I mean, if your pro forma isn't, precise enough to go monthly, that is not a good thing. So that would be the one thing I would also look at for models is does it have a monthly breakdown for the pro forma? Because what happens if an investor asks you, what's the cash flow for month 17?
Yeah, they might.
They might.
Let's see here. Oh, Nick, yeah, I did mention it. This will be available via recording. Got a busy day tomorrow. I'm going to the doctor. Nothing serious. Don't worry. But I will. I'm gonna get that out. And like I say, it's evergreen. You'll have it forever. So if you feel like, yeah, you had to be rushing around taking notes, don't worry about it. It's all recorded. And look, Justin's saying great. Thanks for coming, Justin. I see a lot of familiar faces. Appreciate you all hopping on. Anybody has another question? Going once, going twice. Don't worry.
I'm gonna sneak one more plug in.
Okay.
I plugged in. What did I plug? I plugged the website, or the model, the book. Now I'm gonna plug our event in September.
Oh yeah.
So if you want to hang out with my team and partners like Rick and some of the family offices and private equity firms that are part in my network that we've done deals with, check out the event we're hosting live in New York in September. It's our second go around on hosting an event. It's gonna be really good. We're only gonna have about 100 people there, so it should be nice and intimate and a great opportunity to learn and network.
Absolutely. That event looks cool. Looks deluxe. I'm also putting my information in there in the chat box. If you guys ever want to hop on a call, talk about future deals, talk about what's going on right now, just talk shop. I'm always available. And, we're going to continue to do these webinars where we bring on great guests like Rob. And again, Rob, thanks for making the time. Rob's not getting paid to do this and really just gave out a lot of tremendous free information. So really appreciate you, man.
Yeah, no, we love working with you. You're a great partner, and this was a great time. So hope everyone got a ton of value in this call, and definitely reach out to Rick for more good stuff like this.
Absolutely. Okay, everyone. Thanks so much. We'll see you next month or maybe 2 months. We'll figure it out. I got to find out the next topic. If you have an idea for good topics that you want to hear more about, shoot me an email. Always open to ideas.
Awesome. Thanks a lot.
All right. Thanks, everyone. Good night.